Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This episode is going to be focused on the S&P 500. We have a lot to cover in this video. The markets have been going wild over the past few weeks. We have the S&P 500 option speculation index hovering between 1.3 and around 1.6 here. If we zoom out over the past 20 years, there's only been one period of time with so much option speculation, and that was in 2000 right here. So that just gives you an idea, yet again, of the type of environment that we're currently in. We have a tremendous amount of retail investors in the market, a tremendous amount of speculative behavior, and so that increases the probability of seeing big moves to either side, and that's exactly what we think is happening. We're in a speculative market environment and likely heading into a long-term top and eventually bringing about the end of this 12-year bull market that we've been in. Now, in this video, we're going to take a look at the current technicals on the S&P 500 from a short-term standpoint, discuss what kind of price action we could see over the next couple of weeks, and whether anything has changed in our broader outlook for the stock market, whether we still believe that there is a lot more upside to go before we do make that significant bull market top that we've been talking about. We've got quite a lot of very interesting stuff to cover in this episode, so make sure to pay attention very carefully. Also, don't forget to click on that subscribe button if you want to follow these markets with us. And now, without further ado, let's get right into it. Now, I want to begin by taking a look at one of the indicators that we were watching as the markets were bottoming here. That's the inverse ETF volume, right? So that's your perfect contrarian indicator. If there's a lot of investors piling into these ETFs, it's often retail investors that like to trade with inverse ETFs. If you've got a lot of retail investors going all in to inverse ETF, you see the volume spike, and that often corresponds to capitulation moves. You see these spikes in volume very close to significant bottoms in the market. It happened on multiple occasions here throughout 2021, right here, and it happened again on that recent low. We saw a spike in inverse ETF volume, and that led to a significant bottom, and since then the inverse ETF volume has come back down. So all of these traders that were invested into these ETFs had to sell their positions on this leg up, and that's the equivalent of buying the S&P 500 when you're selling that inverse ETF. So that pushes the market even higher. So that definitely fueled a rapid recovery on the S&P 500. In fact, if we take a look at the actual sentiment in the market right now, we take a look at the AAII bulls survey. This is the number of bulls in the stock market, right? It's a survey where they ask a simple question: are you bullish or bearish on the stock market over the next 6 months? And that gives you that indicator. And you can see we went from extreme fear right here at around 20% of people actually expecting upside in the market as we were bottoming here. And with that recent recovery, we saw a massive spike up from extreme bearish to almost extreme bullish. And so here in the last article that we posted on gameoftrades.net, we took a look at that, and we wanted to actually find out how many times that happened over the past few years, all the way back to 2010, how many times we actually had that type of move. And it happened right here, right after the November COVID vaccine announcement, where the markets went from extreme bearish to extreme bullish rapidly. In 2016, when Trump got elected and the market started to price in tax cuts in 2013 and in 2010. And in all cases, it led to upside in the markets. So that's definitely a nice thing to see. It's a positive development to see such a rapid improvement of sentiment. It tells you that all these investors that were bearish on the markets are going to be coming back in. By the way, if you're enjoying this video so far, make sure to smash that like button. If you enjoy the analysis we provide, our convictions, the way we present all of this information, make sure to let us know. It takes a couple of seconds and it's so appreciated. Now, just because we're seeing a few bullish developments here and there doesn't mean that it guarantees short-term upside. That's far from being the case. I don't pretend to come on here and tell you guys what's going to happen over the next few days. Frankly, I have no idea. What we try to do in these episodes is provide a broader outlook to try and identify larger trends and take advantage of low risk and high reward opportunities like this bottom was back here in October. In fact, if we jump to a daily chart of the S&P 500 here, and I'm going to jump into some technical analysis here, there are a couple of worrying developments that need to be resolved here. We're making a higher high on the S&P 500, but momentum is still forming divergence. This is the RSI, it's a momentum indicator, and you can see what's happening here. We're making lower highs and lower highs here, yet another one, while prices continuing on higher. So that's called bearish divergence, and it increases the odds of seeing a pullback. We need to see momentum burn through these divergences if we want to call this rally from a technical standpoint a true recovery, a true healthy uptrend recovery. If that doesn't happen, we could see a little bit more consolidation before we actually resume that uptrend. So short term, very difficult to say what's going to happen here despite our broader bullish outlook right now. We also have bond prices at support here. This is my chart of TLT, the Treasury Bond ETF. And you can see here we have a beautiful downtrend on TLT. We were calling for a rejection off that trendline resistance, but we are at support here on this bullish price channel. And if you've been following the recent positioning of hedge funds from the Bank of America Fund Manager Survey, you can see that the current positioning on bonds is extremely pessimistic. So fund managers are extremely underweight on the bond market, and so that does increase the potential for perhaps a small rally from current levels, especially considering that TLT is currently at support here. We could see a little bit of a bounce on bond prices, and that would put some pressure on the stock market, right? Bonds and stocks have strong inverse correlations. But in just a couple of minutes, I'm going to give you the flip side of that argument, because if we see a rally in bonds here, that would probably mean that the 10-year yield begins to make a small counter correction here, possibly back down to 1.35 or 1.4, right? When you see bond prices go up, you see yields go down. And so that would be what happens here. But think about what sector that's good for. What sector would like to see a lower 10-year yield? And the answer to that question is technology. If we add a chart of the NASDAQ 100 on here, and I'm going to show you exactly what I mean. We're going to take a look at this chart here. This is the NASDAQ 100 divided by the S&P 500. So it shows you the performance of the tech sector relative to the rest of the market. And you can see very recently, over the past few weeks, we've seen the tech sector underperform here. And what is the primary reason for that? Let's add the 10-year yield on this chart. You'll quickly notice that when yields go up like they've been over the past couple of weeks, tech tends to go down. And when tech goes down, the market goes down because technology is a big leader in today's market. So if we see a small, reasonable pullback on the 10-year yield because big hedge funds position back into the bond market, could that potentially fuel a rally in this tech performance ratio and bring tech to outperform again and push the markets higher? That's definitely possible. That's exactly one of the points that we covered in this article that I posted yesterday on our website on Game of Trades. There's so much information in this one article, taking a look at the entire market health. We post these full overviews of the market very frequently, taking a look at the general market health. We take a look at all the data we have access to analyze the current market sentiment, to try and keep a contrarian outlook on the markets. And every time there's a big move on the S&P 500, we try to evaluate the risk reward and give you guys our convictions and whether anything has changed. And these articles are quite interactive. If we go back to one of the articles that we posted around mid-October as the stock market was bottoming, we talked about that exact phenomenon where we saw the NASDAQ 100 testing a huge level of support. Look at this red line here. The number of reactions you have on this trend line is incredible. And this is actually one of the fan favorite features on our website. People love to use these interactive charts to see how these trades played out. And so you can just press on the play button and you can see since we posted that, the NASDAQ 100 went on an incredible run, pulling the rest of the market up. And now with the recent website update, you can actually save posts and access them on my account. So for example, if you want to save this post for a couple of weeks later and see how some of these charts played out, you'll quickly be able to find them again if you save the post. So I apologize if the market convictions for the short term are quite mixed. There's the possibility that a rally in bonds pulls down the market, but there's also the possibility that it actually fuels a tech run and actually brings the stock market higher. So our short-term convictions here are not very high. The general technical picture right now is extremely bullish. We do have price back within this bullish price channel, but who knows what could happen over the next few days. Now looking out the next few months, heading into the end of the year, one of the charts that we have to take a look at is, of course, the S&P 500 seasonality here that recently bottomed, and now we're heading into that best period of the year. Does that correspond perfectly to the recent recovery we've seen and possibly much more over the next few months? That is very possible. We still have the S&P 500 earnings yield that's so much more attractive than the US Treasury 10-year yield. The 10-year yield right now is sitting at 1.32%. That's a lot lower than the current inflation rate, and the Federal Reserve is not showing signs of tightening. We're not hiking rates. We might be tapering, but tapering is still easing. So in that environment, we're bullish on stocks heading into the best season of the year. I hope you guys enjoyed this episode. If you did, make sure to smash that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.